For years, you knew that inflation was a problem, and of course, if you tracked the prices, you would have seen it. But in 2020, that pace accelerated so fast that it woke everybody up. And in today's video, I'm going to explain how inflation has become not just a problem, but how it will impact everybody on a whole different level starting in 2024. You came here for the truth, so let me unveil that for you. In today's video, I want to explain exactly how it all works and what we are seeing at this time. You see, for a period, we had watched prices going up year after year, and it was pretty normal. That's inflation. Oh well, what can you do? And then 2020 hit, and the acceleration occurred so fast that people started questioning, where is this coming from? Why is this happening? Why am I getting the prices and it's seemingly like we're in Argentina or Zimbabwe because things are going so fast I cannot keep up? It's not just a simple, yes, we experience a few percent of devaluation each and every year. No, we've gone beyond that. And so what I'm going to show you here gets to the next level. And it is right now in 2024 that we have to worry about it. It's not a future event. Let me break that down. You see, we've talked about the usage of credit cards and, of course, student loans. Both of those in the trillions of dollars in the United States, same problem elsewhere. A payment method that some call phantom debt just hit a record. What are we talking about here? This is something that I've been talking about over and over again. New record-breaking numbers on buy now, pay later purchases show consumers aren't getting spooked by the emerging payment method that some economists call phantom debt. U.S. shoppers racked up $16 billion in buy now, pay later purchases during the holiday season, helping to close out a big year for flexible payment options. That's a 14% increase over the holidays. Over the course of 2023, that was 14% as well. $75 billion. Buy now, pay later. And you might think to yourself, well, they've got to pay it, right? Well, not everybody is going to pay it. Although the percentages, the APR that they're going to experience for this is going to be a lot worse than their credit cards. Let me tell you, in most cases. Some of them, there's a way, equal payments. We're going to make it all fine for you. But let's be honest, the vast majority of people using this are probably already too far in debt with their credit cards. They've got rent, they've got all the bills, they've stacked up. And so they cannot pay what they need to. This is the last resort. Or maybe they're not good with money and they're just spending it all. And this is, hey, we have access to it. Sure, I'll do that. These services allow shoppers to split the purchases into installments. Some options are interest-free. That's important to note. Some of them. But I think there's a catch to that as well. Consumers typically make payments over 4 to 6 weeks. Some allow for longer and so on. You've seen this as well. I have noted basically everywhere. You go to checkout online, buy now, pay later. I remember getting this somewhere and the item was just a few dollars. It was definitely less than $20. And I was given the option to pay in installments. It just seemed odd to me that something of a purchase like this would even have the ability to do a buy now, pay later. But that's the world we live in today. And you are going to see this more and more and more common. This is something that we should be paying attention to because it tells us what's going on with credit cards. They are already at a level people can't pay. And Walmart is adding these to the self-checkouts where you're going to be going through. You're going to be scanning your items, right? Because they got rid of the cashiers. And now you're going to see, oh, I don't need to pay this today. I could pay it over the next 6 weeks. Great. Pepsi and Lay's dropped by one of the world's biggest grocers over price hikes. And this is part of my pronunciation. Carrefour, one of the world's largest grocery chains, they told customers that they're pulling Lay's, Doritos, Lipton teas, and other PepsiCo products in protest of increased prices. Look at this, 12,000 stores globally, but the stores in France, Italy, Belgium, Spain will be affected. They're saying, no, our customers don't want that. And so as a result, you increase the prices too far, we're going to pull them out of the store. Now, That's potentially good because this company might go back and say, hey, we're going to squeeze. But what are they going to do? Like, let's be honest for a moment right here. What do you think PepsiCo is going to do with this? Are they just going to say, all right, well, we lost the biggest supermarket on earth. Yeah, okay, no worries. Are they going to bring their prices down? Maybe. But what's more likely? They're going to go and they're going to create new products that are shrinkflated. Oh, that's right. You remember your can of Pepsi used to be 333 milliliters or whatever, and now it's going to be 233. Oh, we brought our prices down or we kept them at par, but there's less stuff in it. You're going to get shrinkflated, or they're going to do the skimpflation, which means, oh yeah, you know how it used to be all these like real natural ingredients? Oh no, now we're just going to put some, sawdust in there and fill you up. That's what's going on. You're going to see this, and it's going to take place all over the world. You see, we've gone to a point at which inflation was, things are getting more expensive these days, to I can't do it anymore. That's when you know the consumer has had their back broken. You see these two articles, connecting them in. Now I'm going to take you through the chart GPS, and I'm going to show you one after the other, and then at the end, something very important to tie that all in together. Here we have it, inflation, a 3-act play. Some suggest that what happens during these periods of time is that you have a surge of inflation, then things kind of get, all right, here we go. Usually there's that second stage where people, that's it. That was probably the it of inflation. They get too relaxed, and then inflation surges beyond that. If we sort of pull that into today's world, right now the expectation is that inflation is coming down, things are getting easy, and then the Fed's going to cut rates. If the Fed cut rates, that means that your risk assets, your Bitcoins, your, the hot stocks, those are the type of things that start to surge up. That's what you need to understand. That's when the Fed cuts rates. That's when the quantitative easing takes place. Those give a risk-on signal, a green light, that these are the things where you got to put your cash. Why? Because the currency is being devalued, and so it finds think about this. Those risk-on ones, imagine they get the green light first. And so the money flows there. However, other things that are actually safer investments, the money then flows in that direction. But the first place is the riskiest ones, usually. And that we could see that with Bitcoin and so on right now, where, let's be honest, it is considered to be a risk asset. Risk on? Okay, let's go invest in the paper assets. Let's go invest in the Bitcoins and so on. That's what could very well happen. Again, and we've already seen a big surge in some of those things since the Federal Reserve has kind of started hinting that, hey, we're getting towards the end of this rate hike cycle. A holistic look at inflation shows that it is still elevated. So when we see it, though, we're way off the top. There's no question about it based on many measurements. But using their measurements. And I do this all the time, and then I see the comments in the thing. Let me just address this really quickly. We're using their metrics, okay? This is broken down as CPI, core PCE, all those things, okay? That's the general measurement of inflation. Why? Why would I know, write books about it, about why their measurements are wrong? And then at the same time, I'm saying, let's look at their measurements. We need to understand their measurements because that's what businesses, that's what the central banks, that's what everybody, basically investors, are all going to be looking at. They're not looking at the shadow stats inflation. They're not looking at trueflation. They're not looking at any of those things. That's for you and I to know. That's important because it gives us a real idea of what's happening, but businesses aren't going to look at that stuff. So we need to know the fake stuff too, the manipulated stuff. That's really important. There is a reason to look at the manipulated stats. US wages primed to re-accelerate next year. That would be a problem for the Federal Reserve, but that would be great for people if it was true. I'm not so sure that it is true. just in general. If people are in a job and their employer can keep them there at a certain wage, certain salary, then they're going to keep them there, obviously. But maybe this is because of minimum wages. This could be various things. But ultimately, businesses will be firing people or will not rehire people that they did fire if they can replace them with AI, robotics, and automation. All companies, all of the conference calls are talking about what? AI. Why? Not because they want a more compelling product, not because they want a better service to offer, but because they know it can cut costs. They can hire a couple engineers. That engineer could program and they can eliminate jobs. This is what they're talking about. That's what they want to achieve. Anyway, who knows where they'll get to. But we'll see what happens as it relates to this. The Federal Reserve doesn't want to see wage acceleration because that means that's inflation and then they can't cut rates. Or at least they don't have an excuse. This is showing us the effective rate loosening has already been large. When we look at it overall, what has happened, financial conditions broadly, what has happened, that has started to come down. That is a fact. It's into a contraction, as they say here, but look at it for what it is, okay? Everything, yes, but you still, the individual, don't experience that. You experience higher prices everywhere. So that's the way I look at it, right? I want to look at it from the people's perspective. Supply chain pressures are rising again. This is largely just due to what's happening in the Red Sea and so on, but you could see it right now. Looking at the misery index says that the worst is over. So what is that? It's the sum of the unemployment rate and the inflation rate ending in 2023 at 6.8%. It's the lowest point since March 2020. Okay. And so that has come down. That's the misery index, putting those two together, suggesting that has bottomed out. Okay. But whether it is or not, I don't know. People say that unemployment will rise considerably. It has stayed within that 4%. We need to go. Many stats show when it gets over 4% on the U3 unemployment rate, that's kind of the big thing. But look, people got 2 jobs, 3 jobs, 4 jobs, 10 jobs. The numbers are skewed. Either way, there's many different indicators that show, kind of soft landing or maybe no landing at all. And we go up from here. Inflation is going to go wild. Please understand the whole message of this video. You got to be very serious about what's happening with inflation and get ready for what's coming, because your prices that you pay today will seem like nothing. You're going to be shrinkflated away. That bag of chips is going to be just a single chip in there by the time they shrinkflate it all the way down with the way the currency is going. Goods prices. We keep hearing, I don't know where they're seeing this. If you're seeing it, please let me know. And of course, anytime we see an event, let's say egg prices. Okay, there's a flu that happens and oh my goodness, the prices spike up. We can't compare that particular shortage, like what happened with lettuce. Oh, we got to recall all the lettuce, so suddenly the price spikes up. That should be discounted when we look at year-over-year averages and things. You can't include that. The same thing applies everywhere else, okay? When there's a spike for some reason, let's make sure we understand that. In general, though, goods prices have gone up year-over-year, not gone down, but the indicators are telling us they have gone down. It's wild. I mean, why? Why? If you experience that, please let me know in the comments below. I want to hear you. Home prices are up in all major U.S. cities except one. The Austin housing market has whiplash. And that's kind of what I'm saying here, because the prices went wild on the way up. So certainly you can have that whiplash effect. Okay, I just want to make that clear. If you are in a circumstance where you need some assistance, that's why I linked up with Money Pickle, because Money Pickle offers free CFP and fiduciaries so that you can get advice directly from them. Okay, and it's, like I said, it's totally free. You go to the link in the description right at the top there, and that will bring you to their page. And when you go, you are actually able to, pick on the calendar exactly what day you want. You get it right away. It takes literally just a couple minutes, and you'll be scheduled with one of them. They'll help you out. Link in the description. So what am I saying here today? It's that inflation is already a problem, but in 2024, the expectation is that that's the beginning. That's the spark. That's when things get real hot. There are multiple events taking place in March of 2024. And that, I believe, will be a pivotal moment and something big we can expect. There's no question. The understanding here is that the prices of things you pay today will seem like a discount in this near future. And so we have to do everything we can to preserve our wealth. We need to cut our expenses as best we can, but also understand how we can increase our top line as best we can. Okay, that's, we only have so many hours in the day. We only have so much effort we can apply, but we have to do our best. Do not sit back and relax. Now is not the time for that. If you appreciate this information, hit that thumbs up button. When you do that, you not only support the channel, but you notify the algorithm like, hey, check this guy out. So I do appreciate you very much. And of course, I'll see you back here tomorrow. Take care.